Right now, we are in the middle of a crisis, and many people are asking, where do I put my money? What stocks do I invest in? So we're going to turn back the clock. We're going to look at the Great Recession, the financial crisis, to see which stocks performed well during that period of time, which stocks outperformed their peers despite everything that was happening. We can mirror these two together and then make wise investment decisions and choices based on that data so that we know what could happen this time around. Every situation is different, but it gives us some more knowledge to work with. My name is David Quintieri, and I am here each and every day bringing you the latest and greatest, knee deep in the trenches, to give you what you need to know and to get rid of all that jargon, all that fluff. So you want to stay tuned. Let's get into it right away. You came here for the truth, so let me unveil that for you. So 2007 rolls in, and the financial world is facing a tsunami of turmoil. Stocks are nosediving left and right. But amidst the chaos, a few brave stocks stood their ground. That's what we are going to highlight here and now. First up, we have Walmart, the discount retailer behemoth. As consumers tightened their belts, Walmart's low-cost offerings were the go-to choice. Despite the S&P 500's dropping nearly 37% in 2008, Walmart ended the year with a gain of about 20%. That's quite a testament to its resilience, isn't it? I mean, you look at it and see what is happening. People need to buy stuff. They still need to buy. They need to buy their diapers for their kids. They need to buy, whatever the case may be. The stuff is getting purchased. It just depends on where they are purchasing it and what kind of stuff are they buying. All right, then we have flipping over to McDonald's. Just like Walmart, McDonald's was a beneficiary of consumers seeking out cheaper dining options. While the overall market was enduring a severe downturn, McDonald's stock saw an increase of about 8.5% in 2008. Dollar menu to the rescue, indeed. So people went there, they got the cheap stuff that they, maybe didn't in prior times. And this is just one example. So people are making choices. Instead of going to A, they're going to B. And we want to be with B, where our money is at, because that's going to help benefit us, or at least help us to lose less money when there is that turmoil. Now let's chat about Proctor and Gamble. When times get tough, people don't stop buying toothpaste or laundry detergent, right? Procter and Gamble's vast array of household products ensured a steady demand. Even though the stock saw a dip in 2008, it was notably less than the broader market decline. And that's what risk parity is all about. So when we are looking at our portfolio, it's not necessarily just the stocks that can appreciate the most. That would be unwise, because we do encounter periods where things get real tough. We want those stocks that hold steady during these periods, and that's one that some investors like to get into, Procter and Gamble, as well as the next stock, healthcare giant Johnson & Johnson. J&J proved to be a relatively safe harbor in the 2008 storm, outperforming the broader market by a significant margin. Healthcare, being a necessity, made J&J a more resilient choice. You know what else went up during this period? Your thumb. Hit that like button. I do appreciate that very much. You see, with Johnson & Johnson, a lot of times, especially if you have government contracts, no matter if the economy is doing good or bad, that money is still flowing in. So we got to look at that. Look at government contracts and who's getting them. Of course, there's a moral aspect to that, but you have to make these decisions for yourself and where you're putting your money. Ross Stores and Amgen also deserve a shout out. Ross, a discount retailer, and Amgen, a biotech firm, both held their ground impressively during the financial crisis, outperforming many of their peers in their respective sectors. But I think I've made myself clear here. Remember, while these stocks fared better than most, they weren't completely immune to the crisis. They experienced dips. They were generally less severe compared to the overall market. But just because it happened last time doesn't necessarily mean it's going to happen exactly. Now, we are encountering a bank crisis today, sort of similar to the financial crisis of last time, but there's always these different moving parts. You've got to know what we are dealing with. You've got to have risk parity. And another way is essentially some sort of, you want diversification, but not how they tell you to diversify. I talk about this a lot. And I think it's really important for people to be aware of this. Look at the data that they're showing us, that we can get, that we can gather, and make those informed decisions. We want to have a strong portfolio, one that includes names that maybe don't perform the best, but maybe they don't lose the most either. And just by having some of those things in our portfolio, it's going to make a big difference. At the same time, we want to hold real assets, things that are tangible. We want to have, talk about it very frequently, businesses that we can control because we can have the tax advantages, we can actually improve our wealth this way, we can add to our net worth, so many different aspects of it that I love to cover, okay? And we could potentially put our money into a place that I believe is something that could weather any storm. While the whole world is contracting, that allows opportunities to entrepreneurs. Okay, all of this stuff here, I hope it was informative to you. Let me know if you want to see some others like this, some similar videos on other crises, what performed well, what didn't perform well. All of that I can cover for you each and every day. I'll see you tomorrow. Take care.